increasingly see China as worthy of a standalone allocation, separate from the rest of EM. And I think for all the reasons that recently have been highlighted, of course, as China somewhat decouples both from a technology perspective, but I think even broadly, you see that the economy, just like Prashant pointed out, it's more domestically driven, and it's less correlated both from a policy cycle and a growth cycle. So you're getting some diversification there from China, but as well, we increasingly see the world from a tech and innovation and productivity standpoint being driven by these two poles, essentially China and the US. And then in addition, China's just sheer size alone, I think, necessitates a separate standalone allocation. But when you think about the rest of EM, I think long-term capital market assumptions is something that's interesting to mention, because I mean, we do them at JP Morgan, most asset managers do them. But if you look back over the past 10 to 15 years, most long-term capital market assumptions for EM have been way off, particularly say EMX China. And EM, the way I tend to look at it, it's more of a tactical position versus a structural position. It does well when the dollar is weak, commodities are up, when the EM-DM growth differential is widening, and when trade is then naturally strong as well. But it's hard to make a structural case for EM ex China. You don't really see productivity increasing dramatically. You don't see reforms increasing dramatically. It's hard to make that long-term structural case. And then on the back of that as well, you haven't seen earnings really either over say an extended period of time outside of China. So we're increasingly looking at China as almost separate from EM, and then we look at more of a tactical case for EM just based on where we are with global conditions. But don't think that China really is driving us to take a more positive view of the rest of EM. We're just looking at it as a separate allocation, more or less.